All
Good
right.
afternoon, everybody. Wanted to introduce Daniel here with Equity Multiple. Z and get going in just a minute. I wanted to thank everyone for being here. We know everyone has busy days, and taking the time out of your days is important to us. Obviously, we're going to have a replay on this particular investment opportunities, I should say, with Equity Multiple after the presentation concludes. But yeah, just in general, we want to get information out there to our audience and to basically anybody who would consider this as an investor on what opportunities there are in the market, because we do realize there's not a lot of light shed on our particular niche of the industry. So that being said, go ahead and introduce us to Equity Multiple, Daniel.
Great. Appreciate it, Nick. Yeah, Equity Multiple is always looking to partner with high quality custodians and, get the word out about not just real estate and commercial real estate, especially in this type of market, but trying to get the word out about how we approach real estate and how we approach real estate investing. So like Nick said, I'm Daniel, Director of Investor Relations at Equity Multiple. I've been with the company for just about a year now, and we are growing pretty rapidly. We just finished our Series B, have a lot of good investment, but enough about the broad strokes. I'll share a couple quick slides and just want to make sure everyone knows that I'm probably going to be going through a lot of information today. We've got a broad swath of investments, but my team and I are available for one-on-one conversations, phone calls, emails, text, whatever, to talk through not just the specific investments that we have, but how real estate investing works and how you can get involved with commercial real estate investing. So I'm going to go ahead and drop my scheduling link now. It will drop you onto my calendar directly, so you get access to me. I'll post that at the end as well. So save that from the top, or don't worry, you can always get it at the bottom when we finish the presentation. It won't be long. We'll take a break in the middle to answer some questions. So drop them in the chat as you go, and I'll try to get them as quickly as possible. But with that being said, let's jump into the presentation. So Equity Multiple, we are a simplified way to access real estate and high yield, high return yields, real estate across various different asset classes and return potentials. A little bit of background. We were founded about 7 years ago, 2015. We've had a pretty good track record, 17% net return over the life of our investments. That's average across both our income producing investments in the debt category and the growth investments with our equity investments. We've got a dedicated asset management team, which is a little bit different than the way that our competitors might approach real estate investing. Some will just throw up investments and leave it to the investor to do the full due diligence. You're in that crowd of investors investing as a small LP. Equity Multiple pools investor capital, and we invest as a larger LP on your behalf, often with major decision rights, which is in the event of default or in the event of something going wrong, we take control of the property instead of being a very small limited partner in that equity. That dedicated asset management is where we, I think, make our differentiation, meaning that we've got a team of 6 professional investors and managers here that help guide our sponsors through decisions on the properties, renting up the property, decisions on how best to market the properties, and then maximizing returns for our investors. We've got a whole sorts of real estate that we'll get into in the different categories, from short-term notes to income and cash flow generating debt investments that are lending money to real estate backed sponsors, and then all the way to GP investments on equity, which is the highest potential return and sometimes some of the highest risk. But we're really proud of the platform that we built, and we'll get into a little bit more of the differentiation here. Like I said, founded in 2015 by Marius Schulson and Charles Clinton. Charles Clinton is a successful securities lawyer, and Marius Schulson is our CIO, who has decades of experience in the real estate sector. What they found is that we didn't have access as individual investors successful lawyers and successful investors who didn't have access to the deals that they were themselves working on. To be an accredited investor, or it was not good enough, you had to be an institutional investor to access a lot of these deals. So with the Jobs Act in 2015, it opened up a whole can of worms for investors to get access to a lot of these various deals that we've had a lot of success with over the time. And really, we wanted to build that streamlined platform to give regular individual investors access to the asset class that has been a cornerstone of institutional portfolios for decades. So you might be wondering, what is that private market CRE that we're talking about, and how does that fit into a portfolio? So we'll start pretty basic, and some of you might already know or have a sense of what real estate investing is, but it's a little bit broader than a lot of people might realize. Like I said before, it's that asset class that's been a cornerstone of investing for institutional foundations, endowments, those larger players for decades. There's a lot of different types of ways to get access to commercial real estate. That real estate can be a debt investment where you're lending money like a mortgage investment, or it could be a preferred equity or common equity investment where you are participating in the potential upside of the investment. There's a lot of different sectors, everything from the common multifamily or office portfolios to things like car washes, campgrounds, RV parks, even boat marinas, if you could believe it. Those are all sorts of real estate and asset-backed investments that have a bit more tangible assets to them. So instead of investing in private equity, where you're investing in the story and the growth of a company, which is all very important, or even investing in stocks and bonds, which should be, I think, a foundation of any investor's portfolio. You know, I worked at UBS for 5 years or so, working in private wealth with pensions and foundations and endowments, and everyone had that core stock and bond portfolio that they had. But like we've been circling around, everyone's trying to find something else to put in their portfolio to diversify their portfolio. And having something that's a bit more tangible, like real estate, even in a downturn, you've got real drivers of those returns. So that's where we see everything. It's everything that you can invest that's tangible real estate backed investments. There's all sorts of different ways to get access to commercial real estate as well, or even real estate investing. Some of you might be familiar with public market REITs. VNQ is the Vanguard Real Estate Investment Trust. They invest in a passive approach to real estate investing. You can get access to a bunch of tickers on the stock exchange for direct investment into REITs and mortgage REITs. Fine, it's easy to get access to that, but you're bearing a lot of market risk there as well. Some more enterprising investors, especially those that use a self-directed IRA like y'all, might be even trying to invest in a single family home by yourself, which is another easy way to get access to real estate, but it's a lot of work. You know, plumbers dealing with tenants and leaks and things like that can eat away at a lot of not just the actual dollar returns, but some of the mental burden of dealing with real estate. So somewhere in the middle, we like to see equity multiple private CRE as a great way to get exposure to real estate. It offers a potential degree of alpha, which is that excess return over the market, and it gives you true passive income. It's not passive income in the sense of dealing with a single family rental where you've got to actually work for that income. You entrust your money to a professional manager who then invests that money into real estate, and then you get a dividend or you get cash flow back from your investment. I mentioned before about public markets, and I mentioned before about that volatility if you invest in public market REITs. One of the key differentiators for investing in the private market alternatives is that you're not bearing that type of market risk. You don't see that fluctuation daily. You don't see that fluctuation monthly. You invest your money, you're investing for the long haul, and you're not trying to be a trader with your money. You're really trying to be an investor into real estate. I've used the word alpha before as well when talking about these types of investments. And alpha from a financial perspective is the ability to gain an outsized return for the investment that you make. And when you invest in private markets, what you'll see is you're getting that private market premium, because it's not just the investment that you're making your money on, it's the structure of the transaction. When we invest, especially in things like our mezzanine debt, our preferred equity, or our senior debt, we get a lot of rights and control provisions along with those investments, which we're able to structure the transaction to provide that upside potential and minimize the downside loss potential as well. So it's kind of the best of both worlds. You're getting exposure to real estate, you're getting professional management, and you're getting the less correlation to stocks. One of the major downsides to investing in the private markets that a lot of investors see is you have to lock your money up for some certain amount of time. That illiquidity or that liquidity loss is actually made up in a potential return driver as well. Always trade-offs when it comes to those investments, so I'm more than happy to talk through those with you later. But unlike some other private market investments, our CRE can have turnaround times of between 12 and 18 months, and not typically longer than 7 years. I mentioned before about institutional investors liking this type of investment. And the typical individual investor has less than 10%, sometimes not even any allocation to alternatives. And some other allocation alternatives might be in things like commodities or traditional private equity funds. But institutional investors have over a third of their portfolio typically that's in those alternative investments. Now, you as self-directed IRA investors know the power of investing in things that are not stocks and bonds, but it's good to drive home how much those institutional investors have invested in things that are not the public markets, because it provides that uncorrelated returns. It gives you a blend of cash flow, and it helps to give you those differentiated alpha sources. It's just been a hallmark of those portfolios for years.
Yeah, one thing I will say about that is those institutional investors have been using commercial real estate more as a core position versus actually having it as an alternative. And I think it's starting to drift more towards the mainstream. So you can consider real estate as becoming a core position, just among investors in general. So
Precisely.
yeah, it's becoming less and less of an alternative. That's just real estate. I mean, there's all kinds of other alternatives you can invest in, but just
Yeah,
in
and
terms of having this position.
we saw it we saw it, over the last decade in this low interest rate environment. There's always been this hunt for yield. And, yes, interest rates have come back up to 5%, but as the economy has picked back up, who knows where those interest rates are going to go. But that's where we're seeing, you notice that the stock allocation has remained pretty consistent, because investing in the economy is still a good trade-off. But you've seen that bond allocation, that fixed income allocation eaten up by alternatives, because the bonds don't really provide much of a hedge when it's not returning anything. It's pretty much investing in cash. It's dead weight in your portfolio, right?
Absolutely. Yeah, absolutely.
Yeah. So before we get into, maybe what we provide and how we approach real estate for investors, have there been any questions in the first part of this conversation? Take a pause if anyone has anything. If not, we can get into how EquityMultiple approaches it.
We haven't seen any come through, so
Good.
we can continue on.
Perfect.
If we do see something, I'll let you know after you finish the thought. But yeah, go ahead. Let's check it
Great.
out.
So, we want to have this platform. EquityMultiple was founded by Charles Clinton to give a streamlined platform for individuals. It's not investing as a crowd. It's not having no help. We have a large amount of investors, over 44,000 registered users nationwide. And we want to give that personal touch. So we have my team on the investor relations team available all day, by phone, by chat, by email. We take meetings all day, every day to discuss not just the individual offerings, but how this fits into the context of investing in general, and then what happens before, during, and after your investment. We've done millions of dollars of distributions. We have actually close to 400 closed investments now, and we've never missed a payment on our Alpine Note series. So we've brought a lot of success. We've got a lot of people who have invested not just for raw dollars raising their money or the value of their portfolio, but they're financing college educations, they're financing retirements, they're financing second homes, and even financing charitable ventures. Donating their proceeds to charitable causes. So it's taking that investment and making it real for people and helping them understand that it's a driver of returns for achieving your results. Being an IRA an IRA investor, you're investing for the long haul and you're seeing the benefits of deferring your investments. So even more reason to look for the long haul for your investments. We've been recognized by several sources as a top asset manager and a top investment platform. Fastest growing companies. Like I mentioned before, we just closed on our Series B. So we're really excited for the growth that's coming ahead there and what's going to come going forward.
Very nice. Congratulations.
Thank you. Thank you. So as I've been talking about for the last 15 minutes or so, we have a much broader array of investments than just your single family homes, than just your multifamily. And we like to look at these as pillars of investing. It's a wealth ecosystem. It's a way to frame your investments for, I like to always call it the type of ride that you're trying to punch a ticket for. If you didn't know that you're getting on a roller coaster of death and you don't like roller coasters of death and you hopped on that roller coaster, you'd not be a happy camper. But if I told you up front, this is the type of ride you're going to get, you could much better understand the type of investment ride, the type of distributions you're going to get, and the type of results that you could potentially achieve with that investment. So again, we're trying to frame this investment in our three pillars: keep, earn, and grow, which are pretty self-explanatory, but we can take a quick walk through those. That keep category is what we see as our savings alternative. It's your ballast, it's your holding money, your dry powder, so that you can get a higher return than holding it in a bank deposit or higher return than a CD. And it's that short term. Any of our keep offerings are our Alpine Note series. Those can be converted into any investment on the EquityMultiple platform at any time, as long as you've invested in the Alpine Note for about 30 days or so. So it's a great way to hold money while you're looking around and investing, screening that next investment. And like I mentioned before, we've never had a missed payment and we've never missed a distribution on those Alpine Notes. Moving up the ladder is our earn category. Those earn investments are those income-focused investments. That's your senior debt, your mezzanine debt, and your preferred equity. They come with contractual payments and typically have much shorter investment tenors than the other investments on our platform. Looking for cash flow, you're looking for a stable, steady return. Earn investments are probably where you're going to be looking at. They're all CRE backed, so things like a senior mortgage, which is backed by a warehouse, or preferred equity, which is covered by a swath of single family homes. All those have contractual fixed payments with some potential limited upside. Like I said, 1 to 3 target term. Yeah, it's they're very popular with income-minded investors. You know, people that might be looking to get a steady distribution after they've retired or things like that.
Yeah, that's great. I was going to ask more about the keep, because we do have a lot of people who are trying to find not big yield. I mean, they would invest in treasuries if we had an ETF that they could invest in, right? So I guess versus treasuries, how would your keep investment look? Like
Sure. Yeah.
Underlying positions.
So EquityMultiple has two things. We pre-fund all of our transactions, meaning that a sponsor comes to us with a great deal. They want to, build a shopping center in Oakland, call it. We like the deal. We like the credit. Between the time that we do our due diligence and then you close on the transaction, there's sometimes a gap between the time they need the money and the time that we are able to raise the money. So we pre-fund that transaction with the money that we have available. And some of that comes from our Alpine Notes. And the Alpine Notes are backed by a couple dozen real estate transactions at the moment, and it's constantly rotating.
Mm-hmm.
And EquityMultiple also takes a first loss position in that, meaning that in the unlikely event of a default, EquityMultiple would absorb the first between 1 and 1.5% of that loss, which would then offset any potential losses to investors. Now, since it's backed by 30 or so underlying investments, the potential for all of those investments to go to zero at once is highly unlikely.
I see.
And when you compare it to treasuries, now obviously this is not government backed, it's not a CD, it's not FDIC insured. However, It has a very attractive yield for before a 3, 6, or 9 month period, and the interest compounds over time. So I think the top APY now is actually close to 7.5%, which when you look to a spread to a 9 month treasury, it's got to be 400 basis points above that, 500 basis points or so above that.
Right. So I would say if your appetite for slightly more risk, probably, it'd probably be a good fit for you. Oh,
Yeah, and it's actually this is our most conservative investment. It's
of course.
short term. If you're comfortable with taking something like corporate bond risk and getting that yield, you could take on an Alpine note, and the risk is minimized there.
That's a good way of analogizing that. That's nice. We did get a question come in just asking about tax reporting for each target profile. I'll say if you do it through an IRA, there's no tax reporting to do, right? Because it's tax deferred. But outside of an IRA, Daniel, how would that look?
Yeah. So with our Keep product, that's a 1099. Obviously, you're correct. With an IRA, you don't have to do that. The earn category, typically it'll be a 1099. And in the grow category, that's going to be a K1. Now, with certain investments in the grow category, there's potential for UBTI, unrelated business taxable income, which if you do invest in an IRA, you could potentially have to file a tax return for those. However, for the Keep and the earn category, it's typically a 1099, which would not require a tax filing for an IRA.
Right. And I think the UBTI tax, or UBIT, if you want to call it that, just transposing the I and the T, it's 37% on that amount.
Yeah, and it all depends on whether there even is UBTI for that year.
Right.
And in the first couple of years, there's typically enough depreciation to offset any potential gains. But we often find investors in our deals that find the returns compelling enough, or it's worth the extra taxes because the higher returns that are offered by real estate are much better than not investing in it. So
offset. Yeah.
And investors, I think, sometimes get turned off by the idea of having to pay taxes on a tax deferred investment. But if the returns are great enough, it could still be worthwhile to defer some money into these types of investments.
Right. And it's not on the entire thing. I think that what a lot of people misunderstand is that the earnings as a whole get taxed at, but that's not the case. It's only a percentage, whatever that percentage is determined to be.
Correct. Yeah. It's a percentage that is related to the UBTI. It's not the whole earnings. And real estate being so tax advantaged anyway by the government, there's a lot of ways to reduce the burden on the taxes.
Good point. Thanks.
Yeah. Great. Yeah. So the earn and the keep are those income producing ones. Keep is, like I said, those super short term cash alternatives, or we like to see them as cash alternatives. And then finally is our grow, which is going to be those highest compounding investments. We have all manner of investments. That 54.3 is the average net return for our exited investments. So it's, I think, pretty compelling. Most of the ones that we underwrite are penciling more towards a mid-20s IRR. But sometimes we have some very excellent results from our sponsors.
Awesome.
The equity types of investments. We'll get into a case study of one that we've got for offer right now, but we cover all manner of asset classes. We have car washes, we have multifamily portfolios, we even have some real estate funds that we're able to bring to the platform. And it's always reducing the minimum to something that's manageable for an individual investor. If you went to a sponsor on some of these funds, or if you tried to get investing as an LP on these, you might have to shell out $100,000 to $500,000 just for one investment. Right. We've reduced the minimum to as low as $5,000 for our Alpine notes, and then between $10,000 and $20,000 for our earn and grow categories, which leads to the ability to make a nice diversified portfolio of real estate.
And you can afford to ladder that.
Yeah. Exactly. And you're able to roll over some of these to the next one. We had a sponsor on two multifamily investments. One was called Whispering Pines. It exited for a high 20s IRR. And then we had the same sponsor come up with a new multifamily investment that significant number of our investors rolled those dollars straight into that next investment. So you're compounding, you're getting access to the same sponsor that you've known, worked with before, and you build confidence in that wealth.
Yeah, that's great to know, especially if you're looking at that long-term grow potential. I would say if you're as an IRA investor, just continuing to keep it invested.
Yeah. And, we have been doing, well, the market's taken a bit of a lull right now. So we're at about one or two new investments per month. But in the peak season of the market, we could be doing a new deal every single week. So you're able to dollar cost average into real estate. And a lot of investors, it's important to do the due diligence on the investment and really dive into the weeds and be comfortable with what you're investing in. But in the same way as you can't time the public markets, to minimize what's known as vintage risk, that is, you're investing in the wrong period of time for private markets, you want to be laddering your money throughout the time that you're investing. So you constantly have money that's rolling in and you're getting the full exposure of the real estate market into your portfolio. Some people will just dip their toe in and then it's a crapshoot. They have a bad experience, they have a good experience.
Mm-hmm.
They're not giving it the full chance to get the exposure to real estate that they might need to have that exposure.
Right. And just in case anybody's unfamiliar with the term ladder, it really just means that you're building, you can call them shelves, you can call it whatever you want to call it, but you do one investment and maybe that's a 3-month maturity, and then next month you do another one that could be a 3 or 6 month maturity, and then you just continue going month by month by month, or whatever the maturity rates are, so that when one matures, you get you get that money back, and then the next month you get another one that comes back to you. So it keeps going down the line, just like going up a ladder.
Yeah, and I've talked to investors before who frame it this way. There's like, well, I want to get to $100,000 per year of distributions, and they're like, if I can compound every year, every quarter, I just put in $20,000 into that compounds over 10 years. Then all of a sudden, the ones that are rolling off every month are, or every quarter are $50,000. And then that's my distributions. And they're seeing as a growing snowball. And as that snowball gets to that point where I can retire, now that snowball is just shelling off cash flow to
Right.
me for my retirement.
Right. It's a great strategy to use.
Yeah. Well, let's get into maybe one of our live offerings now. I think it's timely. It's a great example of the due diligence and the partnership that we've got. And it's a great example of what interesting things can happen in the real estate world when markets move around and you've got the ability to pounce on it. This is a conversion of a failed commercial office and is being converted back to its original warehouse industrial space. So backstory with this investment, this is a very old and famous building here in Brooklyn, New York. I'm based here in Manhattan, and this is down in South Brooklyn, just on the water by the Brooklyn Army Terminal. Originally owned by a couple of large banks and commercial real estate shops who unsuccessfully tried to convert it into creative office space. Those spaces where people can come in, do their photo shoots or do their design work, whatever it is. During COVID, took a hit. Office obviously has been very much in the headlines. Downsizing, moving to low-cost areas, or straight up everyone working from home, so they don't need that office space anymore. This is a foreclosure. So Capstone is the sponsor on this. They are going through a uniform commercial code foreclosure on the property. They purchased the debt on this investment, going through a legal process to foreclose, meaning they take possession of that property from the debtor. And then they're just going to take that and turn it back into industrial space. They've done this before in Europe. They've done this before in New York. They've done this before on multiple types of investments. A lot of hotels, a lot of office buildings in New York. They've done this same strategy. Very timely, right? We've seen several headlines about failed offices or
Record
markdowns,
vacancies.
record vacancies
The
indeed.
Times has been throwing that around all over the place.
Yeah. And even just today, there was one with Starwood, a very large real estate manager, about a markdown and a default that they're going to be going through. So
Right.
great location. New York is a premier market. They are partnering with Portal, excuse me, Portal, which is sort of like the WeWork for industrial spaces. They find smaller people who need industrial space because, if you're an Etsy shop, you're a mom and pop who's just, making widgets and you need to ship them through Etsy, but you're building up an inventory. You don't need 10,000 square feet of industrial space. You need 1,000 square feet. Well, most brokers are only going to sell you 10 or 50,000 square feet. So you get Portal who says, okay, if I can find 10 people who need 1,000 feet, I can sell 10,000 feet. They're brokering that smaller space. So Capstone is taking possession of this. They're going to partner with Portal, who's a great person to put in smaller mom and pop shops. And then they're selling that rent for a significant premium to market, just because they're able to break it down into those smaller spaces. High cash flow potential for this one. Once they take possession, they'll be able to refinance to a fixed rate debt, which means the cash flow just increases significantly. And 5-year term, which is pretty midland for the whole period, and a greater than 25% potential IRR that we're looking to pencil here.
Do you know what the typical, I guess, rate increase would be on something like this? Because if you compare it to self-storage, I know that they will typically have rate increases that no one really cares about.
So I know the market rent per foot for warehouse space, if you're buying a large plot, would be about $20-$25 a foot. Portal is going to go and turn around this and rent them to the individuals for about $40 to $50 a foot. So they're taking their spread, and then they're shorter term leases, but Portal's taking the risk of filling those spaces and paying Capstone that $20 a foot. So we're getting market rent, and not having to worry about filling a space. And the property is already, I think, 50% filled with a large soccer tenant. So there's a large indoor soccer field that's taking up a significant part of the field, the space. And there's all this other industrial space that they're trying to rent out to regular industrial users. So warehouse type space.
That's good to know.
Yeah. Okay. A lot of shots on goal, no pun intended,
right?
With this one. But it is, it's available now, $20,000 minimum. We've already sold about $1 million of the initial funding on this one. And it's going through the foreclosure process now. So very exciting to work with Capstone, who's done this before. And I think, again, just a very timely asset class and timely strategy, and not something that you see on a lot of other platforms. It's not just buying a bunch of houses and flipping them, or buying an apartment building and renovating it. It's a very unique path to ownership that is not accessible to the individual investor. But if you partner with someone like EquityMultiple, who's got the relationships to work with these larger sponsors, you're getting access to an asset class that not many people have access to.
Yeah, that's very different than being a landlord. So let's take a look at the next one.
Yeah. The last one is we'll finish where maybe a lot of people will start, which is our Alpine note. Like I said before, it's what we see as an alternative to savings, and it's a great place. A lot of investors start here to try out the platform, get that first distribution, make sure that we're not some shady people on the internet, and see their money grow in a very tangible way. Put $5,000 in, get $5,000 and $50 back. Very, very easy, very safe. And you can see it compounding over time as you're doing an analysis of all the rest of our deals. So you put in your ballast of money here, you evaluate some of the deals on our platform. And like I said, if you call me up and say, Daniel, I really like that Brooklyn Whale, I know I've been in that Alpine note, what can I do? Well, we can convert that money into any of the deals on our platform. You just have to let us know. And then 30 days later, we can put it into that investment. So like I said, great way to start. and people have, we've done $400 million or so of real estate transactions on the platform. So we've certainly done our due diligence here.
Good to know. That's a good way of explaining that.
Yeah, and that's what I had for a presentation on equity multiple, how we approach real estate. I'm here as a resource for you. Like I dropped in the chat before was my my scheduling link. I will drop it again, even though it's up here on top, but just so everyone gets that notification. You can schedule a half-hour meeting with me. I'll give you a consultation. We can talk through the platform. And then if you invest with equity multiple, your first investment will come with a 1% return boost, meaning that for the period that you're in the investment, you'll have basically a waived asset management fee, and you'll be able to get extra 1% on your return over the year investment. So a great way to start and a show of good faith for partnering with Rocket Dollar.
Awesome. Good to know. Also, in terms of partnering, if anybody is opening a Rocket Dollar account for the first time, maybe you've already invested with Equity Multiple and you're just here to find out a little bit more about self-directed stuff, there is a discount code that we can give you. Off the top of my head, I don't know what it is. I think it might be Equity Multiple, but we can follow up with you about that, or reach out to Daniel. I'll give it to Daniel, and
Yeah.
he'll have that ready to go. But I don't see any questions coming through, so I guess that means you covered everything anybody was interested in.
Well, I appreciate the time. Like I said, I'm here. I've got a lot of experience talking about these types of investments. My job is to connect any investor to the right information. I'm not selling you anything. I don't make a commission. I'm here to give education, and I'm here to help you understand whether real estate is a right investment for you. So schedule a meeting, drop me a line, and we will get you the information you need. But Nick, it was great to talk to you. Really hope to this is informative for you, and hope everyone has a great rest of the day.
We're always happy to host you, Daniel, and the folks over at Equity Multiple. So if you guys need anything, just let us know. To everybody else who joined, really appreciate you being here and taking the time. Enjoy the replay. Send it to your friends if you want to. Thanks a lot. Everyone have a good rest of the week. Cheers.
So long. Cheers.